So let's bring in Ryan Leman. He's an advisor to the board of directors at Security Capital. Ryan, welcome to the show. What kind of number are you looking for from the data later today? And what is it going to take to get the Fed maybe to take a bit of a breather?
Well, first of all, on the unemployment side, we don't expect any massive change. Americans are working. The American economy is firing on all cylinders. And what's really striking is the number of Americans who have taken two full-time jobs at the same time. It's at the all-time highs of 440,000 jobs. So basically, this might be concerning because Americans are struggling to meet ends meet, so they need more than one job to do it. But this shows you that unemployment is really strong. The Fed, you have it, they said it. Stop looking for a Fed pivot. It is not happening. This is off our radar for the next 3 months at least. We're not looking at the Fed pivot at least for the next 3 months.
Okay.
All things equal.
In terms of what the market's pricing, we have a chart that tells the story about 2023 and 2024. We're pricing in rate cuts for both of these years. So one line here is for 2023 and the other one is for 2024. We're seeing the market implied change in the Fed rate. Scott Miner talks about a Fed that's not going to stop until something breaks. What if something breaks before the 3-month horizon that you just laid out? Would the Fed pivot in a situation like that? And maybe it's time to start positioning for that from now.
Well, it's not within our forecast or projections that something will break in the next 3 months. We do expect something to break in the next potentially 12 months, all things equal. Things are changing quite quickly. And something has to break to control inflation. Inflation is the worst thing that can happen to the economy. Again, I said it before, I prefer to have something broken or a recession over inflation any day.
All right, with that in mind, where is something going to break? This financial accident that clearly a lot of actors in the financial markets are expecting, where, in your opinion, is that most likely to come through? Is it going to be in liquidity? Is it going to be in foreign exchange markets? Where is it going to be?
It's going to be in Europe. That's what we expect. Something will break in Europe, whether it's a large Swiss bank or another financial institution or something else. Something during winter time in Europe will break, and this will have implication on the US and the rest of the world. In the US, we're closely looking at default rates, and I've shared with you the graphs. Things are still very low, very controllable. On the funding side, things are very calm. The VIX is around 30. It's really a very slow de-risking that we're seeing, and everyone should continue de-risking as we speak. But again, something will break in Europe.
So how does that translate into positioning, right? Because I know you haven't made any big changes, but right now, what are some of the highlights from asset allocation as you go into the remaining period of the year?
50% cash, which has been our recommendation since April. That position has completely outperformed anything else because the majority of it is in US dollars, Swiss francs, Swedish krona, Brazilian real, and a few other currencies. Private equity is the best inflation hedge out there. Nothing else hedges for inflation like private equity. And then there are pockets of stock markets that we can look at. One of them is around here. Currencies are pegged to the dollar, budget surpluses, and oil exporting. Energy has a price. Let's remember that. So stocks here will outperform.
What about the expectations for earnings in the US versus the Gulf? Because on the one hand, I look at what's coming through from Samsung and AMD overnight. I mean, those are shockers. I mean, AMD missing by $1 billion. That's maybe a bit of a flavor of what's to come. Are the expectations more realistic in the Gulf, or they have also catching up to do?
Well, in Europe and the US, it's mainly on the chip side, on the manufacturing side, because the cost of goods has increased for these suppliers. So again, we talked about it, I think, in May, that we see margins compressing, and we're seeing it today. In the Gulf, we do not have this issue. It is not a manufacturing economy. It is an energy exporting economy, and everything is based on that, and everything revolves around that. Hence, we don't see any compression in earnings. We will continue to see dividends paying, and we do think outperformance. The dollar will remain strong over the next 3 to 6 months. Commodities, short commodities ex energy, because again, the strong US dollar will affect it eventually.
Yeah, but it's good news for the Gulf. It's good news for the United States because they can contain inflation, but it's really bad news for the rest of the world. And it could break an economy or two. Do you think that there's enough momentum now for more countries to come together and to reach some kind of international accord, especially as they sit down in New York for some of the IMF World Bank deliberations?
Well, that's why I keep saying all things equal. Things might change. There might be an accord somewhere, an agreement, a political move that would change the course of things. The US is in a good position. The Gulf is in a good position. Emerging markets that have currencies pegged to the dollar who export energy are in a good position. All other emerging economies are in a very bad position.
Ryan, always a real pleasure. Thank you very much for stopping by. That's the Security Capital advisor to the board of directors and a good friend of the program, Ryan Leman.